Hello and welcome to our discussion on business combination, and in this session we will see the business combination during the year. That means instead of acquiring the business on the first day of the year, we are going to see how the treatment of business combination if the business is acquired in the middle of the year. For that, let us take an example. A and B are two companies, and A is acquiring shares of B with the following conditions. The A acquires 80% stake in B on 1st October 2010, and this is the balance sheet on 1st April 2009. So A acquires after 6 months, and transactions during the year, that is 9-10, B sold entire stock for 50,000, and there is a depreciation of 2,000. The other expenses may be interest, and for A there is no sales except depreciation and interest. Now let us take this to the Excel. This is the opening balance sheet of A, and this is the opening balance sheet of B. So these are the financial statements of A, these are the financial statements of B. Let us first prepare the balance sheet, income statement and cash flow for B. So B, if you see the transaction, they sold the entire stock for 50,000. So as usual, we have to prepare the financial statement, opening cash. The sales is 50,000. Let us assume that the sales is for cash, and whenever there is a sales, there has to be cost of goods sold. Entire stock is sold, so there is no stock left by the end of the year, no stock left. And there is a depreciation which says the depreciation is 2,000. So depreciation for the year, as an expense 2,000. And since depreciation is a reduction in the plant, I reduce the value of the plant to the extent of depreciation. Interest, because of accrual principle, we have to show interest. Interest will be 12% of the loan, and we assume that interest is paid, so no outstanding interest, and this is the total expenses. And the profit before tax is 50,000 minus expenses. And if we assume the tax to be 30%, okay, tax to be 30%, so the tax will be 0.30 of 19,000, and let us assume that we pay the tax during the year, no outstanding. So profit for the period, profit after tax, is 13,510. If no information is given, then let us assume that the entire profit is retained, and the cash in hand will be the total payments, okay, the total receipts minus the payments, and cash in hand is 46,010. So that will appear on the balance sheet of B. No change in the creditor, no change in the loan, no change in the capital, no change in the debtor. So the balance sheet of B is done. Okay, so balance sheet of B is because of the incomes, and income is due to the sales, expenses are COGS and depreciation and interest. After we finish the preparation of the financial statement of B, let us prepare the financial statement of A. For preparing the financial statement of A, we have to find the purchase consideration, and the question says A acquires 80% of shares at rupees 60 per share. So A acquires, so the total number of shares, let us see total shares of B, total shares of B, okay, total shares of B is 15,000 divided by 10. So A acquires 80% of those shares, okay, 80% of those shares, so 1200, and purchase consideration is 1200 into 60, because it's given that we are purchasing we are acquiring the business at rupees 60 per share. Okay, that is the purchase consideration. You require goodwill and minority interest when we prepare the consolidated balance sheet, and purchase consideration as we see it 72,000. So let us write down PC is equal to 72,000 and discharge through cash. Okay, and this is what is required for preparing the closing balance sheet standalone. So no change in the creditor, no change in the loan, no change in the capital because you are not issuing shares, no minority interest required, but the purchase consideration is discharged through cash, so cash will go down. Inventories, okay, we'll see inventories will no change. Maybe we can say that. Let us see the transactions of BA. No sales, only depreciation, so sales is 0. Opening cash is 80,000. Depreciation is 1200 given, if I'm not wrong, yes. And if there is a depreciation, the plant value will come down by 1200. Okay, and interest for the period, I pay the interest on 20,000, so 0.12, and let us assume that you pay interest 2,400, and you acquired 72,000 of B shares. Okay, you acquired 72,000 of worth of B share, that is the purchase consideration. So B share will appear on the balance sheet as an investment. B share will appear, and since there is no income, only expenses, there is a loss or a negative profit. So the profit for A will be 50,000 minus 3,600 minus 6,000, and cash in hand is the summation of 72 plus 2,400 is an outflow, and cash in hand at the end of the year is 5,600. Okay, 5,600 is a cash in hand. Cash in hand is 5,600. Profit we have already taken care. No change in the debtor because you have not collected. So consolidated, the standalone balance sheet will show the investment in the balance sheet, and investment will be shown at the purchase price, and the purchase price is 72,000, and the corresponding decrease in the cash has happened as a payment. So the closing balance sheet standalone shows the investment in B, and investment in B is 72,000. To prepare the consolidated balance sheet as we have done in the past, we have to calculate goodwill, and goodwill is the excess of purchase consideration or equity as on the date of acquisition. So there is a need to find the equity on the date of acquisition. Equity on the date of acquisition is a capital, okay, equity of B. Opening reserves 32,000, opening reserves 32,000. Pre-acquisition profit, we assume that this profit has been earned uniformly, so therefore pre-acquisition profit is half of this 13,510. So it's an assumption that our company earns profit uniformly throughout the year. Of this 54,000, A share is 80% and B share is 20%. So that is the A's equities, A share of B's equity, and the balance is the minority interest. So therefore the goodwill will be 28,256. But what to do with the balance post-acquisition profit? The post-acquisition profit is 6,755. Of these, A share will be 80% and B share is the minority interest is 0.20, and this will be minority interest will be added together and A share will be shown along with the reserves. So now we have goodwill, we have the minority interest. Let us prepare the consolidated balance sheet. So the consolidated balance sheet will be the creditors of A plus the creditors of B, okay, plus the creditors of B, the loan of A plus loan of B, capital no change, only capital of A, reserves 46,000 plus A share of reserve, minority interest will be 10,800 plus 13,000, so minority interest, cash of A plus cash of B closing, inventories of A plus inventories of B, debtors of A plus debtors of B, plant of A plus the plant of B, investment will not appear, goodwill we already calculated 28,000, so goodwill is 28,000 and your consolidated balance sheet tallies. Now the most important part in a acquisition during the year, that you have to find the goodwill by calculating the equity as on the date of acquisition. And equity as on the date of acquisition is the opening capital plus opening reserves plus the pre-acquisition profit. Here we have to make assumption. The total profit of the company during the year is 13,510, but we assume that the profit is made uniformly, so 6,755, that is half of the profit is assumed to be pre-acquisition and 6,755 is considered to be post-acquisition profit, and this is the equity as on the date of acquisition. Of thus A share is 80% and minority interest is 20%. In the same way, the post-acquisition profit is distributed between A and minority interest in the process of 80%, in the ratio of 80 and 20%. With this, when we prepare the consolidated balance sheet, as usual, the investment will not appear, goodwill will appear, minority interest will appear, and minority interest is the minority interest as on the date of acquisition plus the profits belonging to the minority interest which is for earned during the period. And goodwill is the purchase consideration minus the equity as on the date of acquisition, and the equity as on the date of acquisition is equity as on the date of acquisition is calculated by taking the profits up to the date of acquisition, opening reserves and the opening capital. So therefore, unlike the acquisition on the opening date of the year, here you have to find out profits earned by the acquiree, the seller, for the period, and distribute that profit between the minority interest and the shareholder. So whenever there is a transactions during the year, an acquisition happens during the year, there is a need to find the equity as on the date, and equity as on the date is required to calculate the goodwill, because the goodwill is the purchase consideration minus A's equity. Thank you.